Welcome to Inside the Markets with John McLeod. Each program, we will bring you insights from top leaders in business, real estate, politics, and more, with the hope their experiences will provide you with the knowledge and understanding to help make your path to success a smooth one. All right, so welcome to another edition of Inside Leadership. Today we're here with Ryan Butler. Ryan is in the Washington, D.C. area, and it's got a really interesting story. Before we get going, I have a question for you. Talk to me about Japanese sweet potatoes.
You saw that?
I saw that, man.
You saw that? Yeah, I went to a restaurant in L.A. with a good friend of mine who lives here now. And at that restaurant, I think it was called like Rose's Venice.
Okay.
Rose's Venice near Marina Del Rey. And I mean, I had this Japanese sweet potato, and the way that they prepared it with like this kind of teriyaki glaze and some other things. And it was just so buttery. And I mean, I was like, why didn't anyone tell me about this before? I was really disappointed in my friend group.
Now, when you get back to D.C., are you going to go on a hunt for that?
I'm going on a hunt for Japanese sweet potato. I don't know where I'm going to find it. I'm sure Amazon could really bring it out of me, but yeah.
That's awesome. Love that. So yeah, had to do a little bit of research, learn more about you. And that was the first thing that I saw. I was like, I can't resist. So Ryan, how did you end up getting into real estate? How did you choose that as a career?
Yeah. So actually, it's kind of a multi-part place. When I was really young, I had a cousin who was doing extremely well in real estate. I mean, he was flipping 10 homes a month, right?
10 a month.
10 a month. He had a
number.
really big business, right? And so from there, I always kind of had that interest.
Okay.
Now, I got out of school, I got my degree, and I wanted to start investing. So I started on the investment side. I bought my first home. It was 2 units, and I Airbnb'd all the rooms and did all types of like short-term rental things. And I mean, I thought I was a genius, so it was great. And then after that, I kind of continued on, did some flips, did some different types of investing. And eventually I fell into sales because I wanted to get into the houses, and realtors were telling me no. So I figured I'd get my license and do it myself.
And when was that?
Now, that was about 2015 when I thought about it, 2016 when I got my license.
Okay, so you're about 7 years now in the business.
Yeah, I'm 7 years in the business.
And your business has grown quite a bit.
It's done all right.
Yeah, you've done well. You started a group called Coalition Properties Group. How did you guys come to meet, you and your 2 buddies? How did you come to meet, and how did you decide to build this team?
Now, how we came to meet was probably more organic. One of my partners, Harrison Beecher, we went to college together.
Okay.
And I attempted to play football, and he played football. So we were we were teammates there.
Okay.
And so that's how and then from there we actually even started getting into business, doing party promotions, kind of that young college age business things.
Yeah.
And that was kind of our first business. So we've been making money together since we were 19.
Excellent. Now, what school did you guys go to?
Georgetown University in DC. Yeah.
Very nice.
Oh, yes. Yeah.
Very nice. So Coalition Property Group do you focus on residential? Do you focus on commercial? Who do you look for?
Yes, we focus on residential. Before I say that, I'd like to say I have another partner.
Okay.
You're going to want to hear about him as well, which is a cool story.
All right. Love it.
And the fact that Keith James,
Okay.
I always say that I picked him up at a bar, which is actually true, where I'd go out and get my clients.
There's a story there.
There's a story there. And so I picked him up as a client. He was going to be my client. And I told him, I looked at him after meeting him for a little bit. I said, man, you need to be in this business of real estate. So he ended up getting his license.
Okay.
And he sold like, $20 million worth of real estate in his first year.
That's solid.
Yes.
That is solid.
Yeah. And so from there, he kind of continued on. He did really well. I did really well. Harrison did really well all individually. And then from there, that's when we looked at each other and said, what would it look like if we partnered together? How much more of an impact could we make together than we could individually? So the power of partnership is a big part of our story.
Love that. Now, how long have you guys been together?
Since 2019.
Okay. So you're going on 4 years now.
Going on 4 years.
Awesome. So you seem to have a passion for work, play, and wealth. So what point in your life did you decide to play all in on that?
Yeah, I think when we kind of sat down as a leadership group, myself, Keith, and Harrison, we looked and said, what is our mission? What kind of impact that we wanted to make? Um, and basically, we just live our mission statement, which is to be the bridge to our community for all things real estate, lifestyle, and wealth building.
Okay.
And so the real estate speaks for itself, right? But then the lifestyle is an important part of that. It's how you interact with your community. How do you give back? How do you have fun, right?
Okay.
And so all of that kind of works together, and then evolving that into, all right, you've done the real estate, you've done the lifestyle. Like, how does this wealth building play into all of this?
Okay.
So it's really about us just living our mission.
So let's talk about the giving back for a moment. What's personally your mission and giving back? What's your favorite thing?
Favorite thing? That's a tricky one.
Isn't it?
Here's how I think about it. I like to give back to the people who are in my life.
Okay.
And so if my client comes and has a nonprofit or they want to raise for a cause, we support them.
Okay.
And we basically amplify those things. And there are certain things in that organizations that we give to regularly now, just because we've just kind of been around. But I'll give you a simple example.
Yeah.
You know, in 1 week, we raised over $40,000 from 2 events.
Awesome.
Right. That we gave to charity. And since 2019, we facilitated over $1 million in charitable giving.
That's awesome.
Yeah.
That is fantastic.
Yeah, so we've been able to, and that's not just our money, that's, you know, raising from our clients, raising from their employers. It's just kind of bringing it all together and trying to help them be that funnel to something.
So you're sharing somebody else's story and passion, getting others involved, getting their buy-in, leveraging that out. And then the charity in the end run is the one who obviously benefits significantly more than they would have otherwise.
Yep.
Love it. Now you have a podcast called All Blends Perfectly. Right?
Yes, we do. Yes.
Takes listeners on a journey based on your passion, right?
Yeah.
So what is about teaching and mentoring that brings you joy?
I think that it's one of those things where it's so fun to share things that you figured out. Because sometimes it took you a while to figure it out yourself.
Yep.
Or maybe it took you longer than it should have taken you, right?
Sure.
Maybe you found out yourself. Maybe someone passed on some information to you that not a lot of people are privy to. And so the ability to share that information and kind of make the playing field a little bit more even in a lot of ways, I think that's where I kind of get drive from that.
Love it.
Yeah.
Love it. So get that out of the way. So read a quote where you said commercial real estate is the best path to wealth with group economics.
Yes.
How have you used syndications? Because that's what you were talking about. How have you used syndications not only to build your wealth, but to help others who may not have had the resources to take on a project like that on their own?
Yeah, I think sometimes we think about investing in such a broad word.
Yep.
And we think most of the times when we think about investing, it really focuses on the return on investment, what type of money you can make. What it doesn't focus on is your return on your time. And so I really think about the journey that I've had as a realtor and trying to evolve to be a business owner and investor. And what I found was that being a business owner is really hard. And so starting 2 businesses, because once you start buying properties that you are actively managing or actively involved in, you're basically running 2 businesses.
Yep.
And that's really difficult. And so what I found is if a realtor can go and generate a really good income, right, take some of that income and then invest it passively, it's a multiplier effect.
Sure.
One, you begin to gather all of the cash flow from these deals, right? You know, real estate first off, right?
Yep.
Like, so it's just like a really easy understanding of an investment vehicle.
Yep.
And so now you take this investment vehicle, you invest in it, and now you get cash flow, you get equity. But the biggest things I think for realtors, because we're real estate professionals, is that we get tax advantages. And we are some of the highest paying professions in the world already.
Yep.
Like, as being a realtor, like a small business owner, like our income rate is really high.
It is.
Right. And so we end up spending so much time. How do we write this down? How do we write this off? And that also affects how you buy other things. The bank's going to look at you and say, well, you didn't make any money this year because you wrote everything down because you wanted to reduce your taxable income. Well, the simplest way to solve that problem is to take your investment money that you're going to invest in and put it in syndications where you can take advantage of cost segregation.
I was going to ask that question. So when you do a typical syndication, actually, let me back up a little bit. What does the process look like? You've identified a property.
Yes.
How do you go ahead and create the investment group?
So it depends on how big the big project is. If I'm doing a syndication, it basically starts with an understanding of the structure.
Okay.
And so there's going to be general partners in the deal. Those are people who are kind of actively running this deal, right? And then there's going to be limited partners in the deals. Those are people who are investing their money and they get the returns, but they don't have a lot of active work in it. And so therefore they don't have a lot of active say in it, at least once the deal gets done. Sure. And so part of what
you got a fan club here, by the way.
What's going on, guys?
Oh, wait a second. It's Kaleo.
This is the guy.
No. So one of the things is good to see you, brother. Good to see you. Good to see you.
Hey, the beauty of live, right?
Yeah, we're here. We're here, and everybody's here. All our 15,000 friends.
Exactly right. Exactly right. So you're structuring the syndication. You got your general partners who are the active day-to-day operations of the investment, limited partners who basically have no say. They put cash in the deal and they get a return.
Yeah. So it's important to vet your general partners because you're putting a lot of trust with them, right? And so I was talking to a friend yesterday, and the biggest thing I told him, he said, "What should I know about syndications?" The biggest thing you need to know is not about numbers, it's about people. And you need to be able to find the right people that you trust with your money more than anything. Yeah. That they're going to do right by you.
That's a very common theme across the board. It's people over anything else. So
people over profits. Yeah.
So on a typical syndication, how many people do you have involved?
So typical syndications, that's a tricky word because
there's no typical one.
Well, yeah, because the deals are getting bigger.
Okay.
Right. But I can give you an example. Yeah. My last syndication, funny enough, probably by the time people see this, we'll have close on it, but it's a 100-unit apartment building. Okay. And we're under contract. It's in Atlanta, Georgia metro area. We bought it for $6.45 million. And so the capital raise on that is $2.3 million. Okay. And so you can split that up however you really want to. If you have one person, good for you, right? Yep. But generally, most people are investing in increments of $25, $50, $100,000. Sure. So on that, you just kind of do the math from that. The average is, call it 50,000 for simple math, right? 50,000. So that's like 20, 25 investors. Okay. And I think I did that right. Maybe it's 40, whatever the math is.
Yeah, whatever the math is. 50,000. So you might have 100 investors on a $6 million project.
Yeah, probably more like 50, I would guess. Yeah, probably 50.
Do you have any regulations or regulatory issues, whether it's with SEC or anybody else?
Oh, yeah, absolutely. I mean, no issues because we're paying really expensive lawyers.
You're paying attorneys to take care of that
to do really expensive things.
Sure.
So they're dealing with all of the private placement memorandums, all of the operating agreements, all of those things are being done by lawyers and attorneys who focus in this.
Do your investors have to meet any criteria as far as whether it's net worth or cash reserves or so forth?
At this point, they haven't had to. Okay. Because all of the people who invest with me know me. Yeah. They know, like, and trust me. These are friends, family. I mean, it's my grandma. My grandma invests with me. You know, she loves getting her check every month or every quarter from the deals that we're doing. So love it. She's putting her money in. So if you're basically friends and family or people who actually know you, not like, hey, I met you one time, but if you've known them for a period of time and they gotten to know you, then you're able to invest without being basically, accredited investor. Okay. Yeah. Excellent. But you can go all accredited investor. There's a limit to how many non-accredited investors you can have, or they call them sophisticated investors. Sure. That you can have in any one deal. I think the limit is 35. 35 non-accredited or non-sophisticated investors. And then after that, you've got to go through an SEC filing or something to that effect. Yeah, you're still going to have to do the filings anyway, but then the accredited investors, that can be unlimited amounts. Okay. There's no limit on how many you have in a deal. Okay. Excellent. So cost segregation, again, typical model. Let's use your Atlanta one because you're closing on it shortly. When you cost seg a $6.5 million building, I'm going to guess you've got
2 to 2.5 million worth of depreciation you can take right up front?
Probably a couple million in the
Okay.
end. Yeah, probably close to a couple mil. Yeah.
Okay. So without getting too detailed, how does the accounting work on that? So if I'm one of the investors, what does that look like for my tax returns this year?
So I'm not an attorney. I'm not
And
a
you're
CPA.
not an accountant, so
I'm
let's
not
get
an
all those
accountant. Let's get
disclosures
all
out there. Real estate dude. so
yeah,
that's good.
yeah. Right. And so also the number that you get, these kind of typical, somewhere between like 20-25% of whatever the purchase price is, kind of thing. But you really have to figure out to go to an engineering firm,
Mhm.
someone who focuses on generating what that loss is on the depreciation.
Okay.
And so I just wanted to kind of say that first. And the way it works is every investor, because it's a syndication, you own the property. You're
Yes.
actually a property owner.
Yep.
And so you're able to participate in the depreciation. And what happens is they distribute a K1, which is a
Yep.
tax form that shows you basically a profit or a loss. Well, because of accelerated depreciation, typically in your first year, you should see a loss or a very low income. Right. But that doesn't mean you actually lost any money.
Right.
So you could have made money on the amount that you put in and still take advantage of the tax situation there.
Yep.
And utilize that accelerated depreciation.
So simple math, as if there's a such thing. If I invested $50,000 in a syndication and there's 100 people in it, and they're all at 50,000. Again, keeping it simple. I've got a 1% share. So if there's $2.5 million worth of accelerated depreciation, I'm getting a $25,000 write-off that year. 1% of that.
Probably, yeah. That sounds about right.
That's pretty solid.
Yeah,
that's pretty solid. That can make a lot of tax issues disappear quickly.
Very much so. So think about it this way: if you had to pay taxes, if you're a realtor and you make $150,000 a year, it's a great income. Right?
It's a great income, and Uncle Sam's going to get 30, 40,000, depending on what state you live in.
Right. So what if you live beneath your means, right, and you're able to put up $50,000 into a syndication? Well, you reduce your taxable income, right, by 30,000 at that point. So the amount of taxes that you'd be paying would be significantly less, right? Basically, you take away however much taxes you would have paid on that $30,000.
Yep.
You don't have to pay any.
Right.
Right. Now, one of the things is you have to keep investing to play this game, right?
Yes.
You can't. It's not every year you have to invest in a new syndication.
Yep.
But that's kind of the, pick your poison.
Yep.
Do you want to just, all right, I'll just pay all my taxes this year? Or you can say, you know what, I'm still just going to invest this year. And I'm going to get the cash flow returns. That way you're getting passive income.
Yep.
And you're reducing your tax liability and you're gaining equity, because usually there's a payout at the end of whenever you sell a property.
Right. And then I'm sure you make decisions based on not just the return on the initial investment, but the return on the equity that's been built up in the investment and so forth.
Yeah.
Have you had a situation yet where you have done a 1031 and taken the syndication from one property to another?
No, we haven't had that yet. Mostly because on the syndication, there's so many people involved.
Mm-hmm.
A lot of people want the money back.
Sure.
So if you can do a 1031 and everyone wants to stay in, that makes a lot of sense.
Sure.
But most people want their money back. So you sell the property, and if they want to get in the next one, then you give them the chance to get in the next one. But yeah, at some point you're like, hey man, I need my money back.
Okay. Got it. Love it. So Ryan, what's the best way for someone to get in contact with you if they're interested in learning more about how this works?
If you're interested in learning more about how syndications work in particular, you can go to investwithryanbutler.com.
Okay.
And fill out a form, and then we'll chat and talk and get to know each other and kind
Love
of
it.
understand what's important to you. If you want to reach me directly, you can also reach me on social media at Ryan Butler Hoya, and then at Coalition Properties.
Love it. And that same thing, if you have a DC area referral buyer or a seller, they can reach you the same way.
Absolutely. DC
That's
Metro
awesome.
to Baltimore, out to Virginia. We cover a pretty big range.
That's awesome. Ryan, sitting here on the Exposition Hall floor at Family Reunion 23, it has been a pleasure. Wonderful meeting you, and I love the insights, my man. Thank you very much.
Thank you very much.
It has been my pleasure. Thanks again.
All right.
Awesome. Great job, bud.
Thanks, man.
Thank you for joining us for another edition of Inside the Markets with John McLeod. I hope you found this topic interesting. Each show we will bring you intriguing and relevant commentary from the top experts here in our market. If you have suggestions for future topics or would like to be a guest on the show, please email me at johnmcleod@kw.com. That's JONMCLEOD @kw.com.